Major banking changes are coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we're now getting word that game-changing regulations are coming to the banks, and this will have a shocking impact on consumers as it will make getting a new loan an outright nightmare. But that's only part of the story, because wait till you see the impact these regulations will have on the financial system and the broad economy. And speaking of the economy, we now also have a new report on the services sector that's showing us that it's far worse than we thought, and one of our favorite leading indicators is validating this despite OPEC's attempt to drive crude oil prices higher. Plus, we have a sponsor for today's show. If you're a sports fan, you're not going to believe this. We have a publicly traded football club as our sponsor today. Not only do they have a really cool story, but wait till you see the chart set up. You may recall the last three companies we promoted on the show, their stock took off. We'll show you why we think this company's stock is poised to head a whole lot higher. Stay tuned to the end of the show for more information, or check out the description or the pinned comments. In the meantime, let's over to the Wall Street Journal, where we pick our lead story up with big banks could face 20% boost to capital requirements. Now, I want to understand on the onset why this is such an important topic, because the role of banks in our financial system in a debt-based system is to lend money, because we need the creation of new money to pay on old debts. So anytime you see new regulation come along that tries to slow down the ability of the banks to create new loans, all of a sudden it means the economy is going to move slower and slower here. And in this case, new capital requirements means banks, you're going to stop lending as much and start putting more money in reserve. The change in which regulators are on track to propose as early as this month could raise overall capital requirements by roughly 20% at larger banks on average, people said familiar with the plans. The precise amount will depend on a firm's business activities, with the biggest increases expected to be reserved for the U.S. mega banks with big trading businesses. So what you're also seeing here is when you have to withhold more capital, well, and you have to put it in reserve, guess what you also have to buy to back that capital? What are you? You're not going to sit on cash. You're going to go out and buy treasuries. Now you think about it, with the debt ceiling being raised, we're actually seeing a future where the 30 trillion debt is going to go to over 50 trillion. You need someone to buy it, and well, who best? So, make the banks absorb a bunch of it. Banks that are heavily dependent on fee income, such as that from investment banking or wealth management, could also face large capital increases. Capital is a buffer banks are required to hold to absorb potential losses. So this isn't just banks in general. This is investment banks. This is pretty much all of the major banks being affected by this. And again, when you have to put more money as reserved as capital, that means you actually have to go out and invest it in something, because sitting on cash gives you no return on investment. So they're going to go out and buy U.S. Treasuries, mortgage-backed securities, at a time when the government needs buyers for this, and you're going to have ready, eager buyers just from the banks alone. The plan to ratchet up capital is expected to be the first of several steps to beef up rules for Wall Street, a shift from the lighter regulatory approach taken during the Trump administration. The industry says more stringent requirements aren't needed. Of course they don't, but could force more banks to merge. I'll show you why that's a terrible idea, to stay competitive, and could make it harder for Americans to get loans. Now, one thing I want to ask you is, do you think that banks need more regulations here? Do you think this is the proper response to what we just saw in the crisis? Do you think, or is something else we should do, or maybe nothing else we should do? But one of the issues here that that people don't understand, and when I refer to them, I mean the regulators, is we need more banks in our financial system, because in a debt-based system, you need money to move. So when you think about taking a loan from a bank and you deposit it and you pay someone else, well, if the bill is paid at the same bank, it doesn't really do anything. What you want is that money to go to a completely different bank, where that bank then lends against that deposit, and that money goes to another bank and gets lent again, and it multiplies out through the economy. That's how you get inflation. That's how you get money growth. And when you look at this next chart, it tells us why bank mergers are one of the worst possible things we could be experiencing if you want to see money multiply in our economy, which we know the Fed and other regulators want to see. Here you can see, now this has been discontinued, but it's the commercial number of commercial banks in the United States. That's a red line. It really doesn't matter because we know the line keeps going lower and lower. And this is the money multiplier, which is the M2 money supply divided by the monetary base. And what it's telling us, as you have more banks in the system, money gets multiplied out through it, which leads to, of course, creating sustainable inflation and money growth. So as we get rid of more banks, which we do that through regulation and mergers, what it means is less money is getting multiplied through the system, and now all of a sudden you have a huge problem. But from a lending perspective, and we'll get to this in a moment, it's also a problem for consumers, because if banks are withholding more money in their capital requirements, it means they have to start cherry picking even more so who they're lending to. And when you start to think about, the small and mid-sized bank failures that we recently saw, why did the big banks not want to see these littler banks fail? Why do they actually inject capital into Silicon Valley Bank? Simple, because those are the banks that can originate loans, because they're not subject to all these requirements. The moment all the banks get subject to this, what you're going to see is lending collapse, money growth collapse, money multiplying collapse, and guess what the economy is going to do with it? Tougher rules were already on the way for the biggest lenders before March failure of Silicon Valley Bank and other banks sent tremors through the industry. Since then, regulators, who have been scrambling for an answer, have said they plan to apply new rules to a wider range of banks because, hey, if it doesn't fix it to begin with, we just need more regulations. As institutions with at least $100 billion in assets might have to comply, effectively lowering an existing $250 billion threshold for which regulators have reserved their toughest rules. And higher capital requirements are unwarranted, according to the CEO of the Financial Services Forum. He says additional requirements would mainly serve to burden businesses and borrowers, hampering the economy at the wrong time. And that is a valid point. Now, I'm not trying to defend the banking industry and say we need to go and make a whole bunch of new loans. What we need to do is create a system where banks can actually lend. So if you agree that we're heading into a recession here, how do you get out of recession? Well, you're going to need money to be created. And who do you need to do it? Well, the money centers, the banks, they're the ones who create money. So even if you lower interest rates, which we know the Fed's going to do during the next recession, even worse if it's a financial crisis, everything's going to be at zero. But if the banks, through all this aggressive regulation, can't lend, it means we're going to be stuck in a slump far longer than we're used to. And while the U.S. banks emerged from the pandemic in solid financial shape, Federal Reserve Vice Chair of Supervision Michael Barr has signaled he believes capital requirements should be higher. Of course, well, all regulators believe requirements should always be higher. The banking system might need additional capital to be more resilient, precisely because we don't know. This is key. We don't know the nature of the kinds of ways we might experience shocks in the system. So you have to love this. He's admitting we don't have a clue how the system is really functioning. We can't anticipate what the shocks are. So since we have no idea what we're doing, we'll just raise the capital requirements and keep our fingers crossed that this actually does something. And he notes that this has happened with recent bank failures. Of course, again, as we said, they have no clue what caused them. But one of the issues here for consumers is if banks are lending less because of higher capital requirements, it means lending conditions are going to tighten. It means money growth is going to slow. And so what we're going to see is consumers go to banks and they're going to be unable to get loans, or they're going to have larger down payments, or there's going to be other mitigating factors to get loans. When you have less money being created, the system doesn't expand. The economy doesn't grow as fast. Even worse, during a recession, when you need new money to pay on old debts, if you have a lack of growth there, you're going to see far more delinquencies and defaults, which of course will lead to a collapse of more banks, which, as you can guess, just led to potentially even more regulation and more capital requirements. Brilliant. The coming proposal is the last piece of capital rules that the global policymakers agreed to implement after the 2007 to 2009 financial crisis. The overhaul forced banks around the world to boost their capital cushions, little good did that do, in hopes of making them better prepared to weather downturns, of course, ones that regulators couldn't anticipate without taxpayer bailouts, which happened anyways. Banks must have loss-absorbing buffers to account for the risks tied to their activities, but regulators believe the way some firms currently measure these risks varies too widely. The last step of the global overhaul is aimed at making measures of riskiness more transparent and more comparable around the world, thus putting a leash around all the banks all around the world, leading to less money growth, less economic expansion, and ultimately more regulation until we eventually see the case, as many of you said, where the government steps in, perhaps takes over the banking system, perhaps even forces lending. We all know this is eventually coming, and you're seeing the beginning stages of it now. And talk about in the beginning stages here, we know the services sector, which was supposed to lead the economy out of the slump, well, now as we've been making the case, services follows manufacturing, and now we're starting to see that's true. This from Zero Hedge, a services survey disappoints in May. Employment, new orders tumble. The S&P Global U.S. Services PMI printed higher at 54.9 for May, but that was fine because the ISM Services, the one that everyone cares about, printed at 50.3, seeing virtually no expansion in May, missing expectations of a continuing expansion in the services sector. And as we pointed out in Zero Hedge, this chart showing both the the S&P Global and the ISM, showing that the manufacturing sector in both cases, the red line, leads the services sector. That means we're likely to see a further decline, as we can see in the data here. As we dig into the report, look at this broad business activity. Only remember these numbers: above 50 expansion, 50 unchanged, below 50 contraction. What do we see? Business activity and production 51.5, minor expansion. New orders slowed down to 52.9. Again, demand going away. Employment, remember this was supposed to lead it going forward. We're going to see these lights out payroll reports, not going to see it going forward. Employment 49.2, virtually unchanged, slight contraction. Supplier deliveries means deliveries are getting faster, 47.7. Inventories going up, demand going down. How about this? Backlog of orders, severe contraction of 40.9. You're seeing everything we need to know. It has, and perhaps the new exports order at 59, showing that only thing really driving here is the weaker dollar, and all this plays now back into the oil markets. We know over the weekend what happened is OPEC cut production. Now they're actually trying to raise prices into the Asian region just to get prices up. But I want to show you how broadly this report was watched and how much of an impact it had on the economy. Because oil prices rise after Saudi Arabia pledges more voluntary production cuts, and this was a brief rise because OPEC Plus made no changes to its planned oil production cuts. However, the world's top exporter, Saudi Arabia, announced further voluntary output cuts, which will be implemented from July going on. And look at this chart of crude oil. This is West Texas Intermediate. It gapped up in overnight trading after that report out of OPEC and immediately came down based on, of course, the ISM Services report showing that the U.S. economy is slowing down and heading in the wrong direction. But one thing you should be excited about, and that's our sponsor for today's show. I'd like to introduce you to our sponsor for today's show, Barrera Holdings, on the NASDAQ symbol BREA. You'll find more information in the description below and as a pinned comment. Not only does this company have a really cool story, but when you see the chart set up, you're going to see why that their stock price is poised to head higher. Let's head over to their website. Here we have BarreraHoldings.com, and they are from local to global, from Milan to the rest of the world. They're putting out a new idea of football, and what they're going to show you is a sustainable approach to professional football. Barrera Holdings Limited is an Irish holding company focused on expanding social impact football by developing consulting and professional football services that build on the legacy and brand of Barrera Football Club. Barrera Football Club is founded in 2000, which despite its amateur standing is unanimously recognized as the third team of Milan. This definition does not derive from the football ranking, but rather from the strong social media overexposure obtained in relation to the many projects, mainly with a social background created through football. The brand's notoriety indices, repeatedly measured and certified, are very significant and clearly defined the perception of Barrera as the third team in Milan, with their focus of the club has always been on the innovative use of football as social, sporting, cultural, and communicative experiment. And I can tell you, my friends, that they are changing the shape of sports. Let's look a little deeper here, because following an initiative by American investors, Barrera Holdings aims at setting up a development strategy whose goal is entering professional football. The choice, however, is not to climb the Italian football pyramid, an expensive, difficult, and probably unrealistic project, but get this, to rather than create a sort of global club with headquarters in Milan and various Barrera branded clubs from first or second division in European football minor countries, from even lower divisions in emerging football continents such as Africa, Asia, South America, with the first sustainability approach, which is a big deal to this organization due to the focus on the achievement of ambitious sporting goals and transfer market the latter with an ESG approach. So this is a very unique organization that's doing some really cool things, as you can see. Barrera Holdings therefore aspires to be a global football group following the example of Manchester City, which has created teams with the City brand in various parts of the world. Unlike the City project, however, Barrera will take different paths and will be much more focused on economic and social sustainability, thus counter-trending the mainstream football approach. So as you can see, they're really doing some cool things, looking at taking on some acquisitions and really expanding their ESG approach to football, which is something that no other organization has done before. But what's really impressive is when you see their chart setup. If you're looking for a really cool trade with a really cool organization, well, check out these charts. Here we can look at the 6-month chart going back all the way to inception here. Not uncommon when you see an IPO stock to come down, but look at this. It's kind of rallied up and then it's pulled back. But notably here we got the 6-month volume profile turned on. We've got the RSI. We can see momentum has been trending positive slowly. The MACD is trending up off oversold conditions here. And you can see right here, if you get a break above, this volume profile line here around $2.83, you can see in the past it's kind of just rocketed up, putting some potential move in the stock up into the mid to high threes pretty easily, maybe even as high as the low fours, depending on what kind of news is going to come out in the future. And here we can zoom in on the 90-day chart. What do you see? RSI momentum remains positive. We see, MACD is validating that. We had some rejection here right at that $2.80 level, which is not surprising. We can see buyers are clearly defined below here, and I'm going to show you that. Sellers are right above here, but as we know, once the sellers get exhausted out, then you can see price quickly moving up to the 200-day moving average at $3 and around 10 cents, where we've seen rejection from there. With this breaking over the 200-day moving average, you can see the stock quickly moving up into the mid threes, upwards into the low fours. But now let's zoom in, because you can really see buyer support here over the last 30 days coming in at these lows, snapping up shares, looking for some sort of news flow to take the stock higher. So there's positive support underneath here from buyers. Looking at the 10-day, you've got some validation there as well. So everything you're seeing here from Barrera Holdings is not only do they have a cool story, but their stock is really poised to go higher. It could take any kind of news now to see that these buyers are in the right place at the right time. The question is, will you join them? But as always, before you buy any stock we feature on this show, be sure to do your own research. Remember, symbol BREA on the NASDAQ. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.